Okay, good morning. Can you all hear me? All right. Okay, very good. So you see, last week we talked about project evaluation and project decision. Whether should we choose which project to invest or which product that we should choose over the taking into consideration of the costing and etc. So today we will be talking about replacement decision. So this is basically comparing a new investment versus an old investment, whether to continue the old investment or move on to a new investment. All right. So let's start with today's tutorial. Let's hope that you have the question together with me. We could discuss this together. So today I'm not using Excel because not so many information, so variables like what we did last week, and there are more different methods to approach. All right, let's look to this first question here. Pilot Plus Pants is deciding when to replace his old machine. The machine current salvage value is $2.2 million. Its current book value is $1.4 million. You can write this down. This is for the old machine. Yeah, you can rejoin. Okay, for those who are still here, old machine. So old machine, what happened to old machine? Let's see. Deciding when to replace it. The machine current salvage value is 2.2 million. The book value is 1.4 million. If not sold, the old machine will require a maintenance cost of 845,000. Maintenance. Okay, $845,000. At the end of the year for the next 5 years, depreciation on the old machine is 280,000 per year. Depreciation 280,000 per year. At the end of 5 years, it will have a salvage value of 120,000 and a book value of 0. So this is now 5 years later. Salvage value 120,000. Book value 0. Depreciation to 0. This is your old machine. So what about the new machine? This is old machine. Info about your new machine now. So new machine, a replacement machine costs $4.3 million. So it's gonna cost you 4.3 million initial investment and require maintenance cost at $330,000. Maintenance $330,000 per year during economic life of 5 years, also for 5 years. At the end of 5 years, the new machine will have a salvage value of $800,000. So salvage 5 years later is $800,000. It will be fully depreciated by the straight line method. Okay, so depreciation you don't know. So basically 4.3 million divided by 5 years. So it's 806. Hope I'm right. Sorry, 860. Okay, 860,000 depreciation per year. This is depreciation. Okay, per year. It will be fully depreciated, straight line method. Yeah, pilot will need to purchase this machine regardless of what choice it makes today. The corporate tax is 40% and the appropriate discount rate is 8%. The company is assumed to earn sufficient revenue to generate tax shield from the depreciation. So now, you are given this information about the old machine and the new machine. So what should you do to do an evaluation on an old machine and a new machine? So number one, okay, what you want to do now is to calculate the NPV for both machines. Okay, you need to calculate the NPV for both machines. All right, so let's look at it. Okay, look at the new machine first. How much or what is the income statement for this new machine? Oops. So looking at new machine, what we do last week is we use the income statement. Okay, do an income statement. So costing, maintenance cost, and depreciation. Maintenance cost here for new machine is $330,000. We calculated the depreciation per year is $860,000. Okay, these two are actually negative figures. You don't take into consideration of revenue again. I hope you remember what we did last week. So from here, you can get your EBIT. Okay, so EBIT negative 330 minus 860,000. Okay, or plus, okay, 330 plus 860,000. This is the costing. So total costing now it's negative 1190000, negative $1.19 million. Okay, and then on top of this, you've got a tax here. Okay, tax of 40% is in the question. 40% of 1.19 million dollar is $476,000. So this is also negative. Okay, why is this negative? This is tax credited. All right, the negative tax implying a tax credit. Okay, so now you can get your net income. All right, you get your net income. So 1,190,000 negative 1,100,000 negative $1,190,000 minus your tax credited. Okay, minus become positive. So here will give you a net income of negative 714,000. Okay, your net income. So in other words, this is the cost of your new machine a year. All right, this is net income, not done yet. You want to count the operating cash flow. So if you remember last week, operating cash flow is net income plus depreciation. So here negative 714,000 plus depreciation of $860,000. This will become a positive one, a positive operating cash flow of 146,000. Okay, negative 714 plus $860,000. Okay, so it become a positive figure. Become 146,000 OCF. So this is the operating cash flow. That means money inflow. Okay, for this machine. Next, you want to calculate the salvage value of this new machine. So let's look back. The new machine salvage value $800,000. Okay, $800,000. So $800,000 you will need to be taxed what, because by right at the end of the 5th year is depreciated to a straight line to zero. So but then in the end you still have a salvage value. So salvage value are taxable. So salvage value 800,000 times 1 minus 0.4, which is your tax. So this will be 480,000. Okay, so this is the actual salvage value you get at the end of the 5th year. So now, if you put this into a timeline, okay, 0, 1, 2, 3, 4, 5. You're having an operating cash flow of $146,000 for 5 years. On the 5th year, you're salvaging your New machine also at $480,000. So total this up. Okay, initial investment is 4.3 million. So now with this info given to you, you can calculate your NPV. All right, calculate NPV, new machine. Negative 4.3 million plus 146,000 divided by your interest is 8%, the discount rate is 8%, 1.08 power of 1, 1.08 power of 2, 1.08 power of 3, 1.08 power of 4, and lastly total up together. 480 plus 146 is 580, 626. Okay, 626, 1.08 power of 5. Total up all this together, then you can get your NPV. All right, total up all this together, you can get a NPV. So see what is your NPV. Calculate your NPV from here. So you will get a negative NPV actually. All right, you'll get a negative NPV. Negative 3390,384.4. This is what you should get. All right. So naturally, when you think that a negative NPV, you don't invest. But in this type of question, when you are evaluating, a negative does not what do you call that? A negative NPV does not significant that this is not a good investment because you did not take into consideration of your revenue. All right. You see, you straight away talk about the costing. Okay. So you are talking about the total costing only. That today worth how much? How much you will spend in the end of the day. So the lesser you spend, the better for you to invest. That means it's better. That's a better choice. So this new machine will end up allowing you to spend almost $3.39 million today for the next 5 years. This is the value that you are spending today. Okay. So let's see if you use back your old machine, what is the difference? All right. If you're keeping the old machine, what is the difference? So I think we've forgotten about the old machine already. So old machine at the current time now is actually still worth $2.2 million. So we will take this $2.2 million as the cost. Okay, because this is opportunity cost. Although you're not buying any new thing, but today you can sell it at $2.2 million. All right, this is opportunity cost. Okay, and it's having a 1.4 million book value. All right, so you need to count your initial cost. If today you sell off this new machine, how much you actually get back? Let's start with the old machine. All right, so the old machine worth $2.2 million today. Okay, the value today present it's 2.2, but then you're not selling, so it's going to be a investment, an opportunity cost. All right, so you want to count the actual value of it because there's tax also. If you sell it now, you don't get full 2.2 you still get a tax on top of it. Okay, so what is the actual value of it? Let's see. So the actual value is supposed to be 2.2 million multiplied by minus the book value first, minus book value of 1.4 million. Okay, then multiplied by 1 minus t. Okay, 1 minus t. No, cannot count like that. Yes, correct. So this is the current value. All right, this is not 1 minus t. This is being texted. Okay, so you are actually, after deducting the book value, you are selling at a higher price of $800,000. $800,000 times 0.4, that means you are being taxed $320,000. So this $320,000 need to deduct from this initial value. All right, so negative 2.2 million plus $320,000, okay, will be, this is the money you get. Okay, this is the actual opportunity cost. This is for an old machine. All right, this is only on the initial investment. That means this is the opportunity cost. Okay, next you need to count the income statement for the old machine. So to count income statement of the old machine, again, to take in the maintenance, take in the depreciation, just like just now. Then you get your EBT, then deduct your taxes, then you get your net income again. So based on the question, your maintenance cost here is $845,000 per year. The depreciation is $280,000 per year. Okay, so these two add together, they give you a bigger total. So it's 1125. Yep. Taxes at 40%. All right, also credited tax, just like just now. So negative minus negative, it become positive. So this value will become lesser. Sorry, your net income will be 675. Sorry, 675,000. Okay, so having your net income add on with the depreciation, negative 675,000 plus 280,000. This will give you your OCF. Your OCF will be less than negative 675. 675 plus 280, 395. So your operating cash flow for your own machine is negative 395,000 per year. Okay. All right. So now you got the initial investment, your operating cash flow, and lastly, you're going to count the salvage value. At the end of the 5th year, you can sell at $120,000. Okay. $120,000, you need to be taxed lah. Oops. 1 minus 0.4. So the balance will be only $72,000. So what are you going to do now to count the NPV? Again, you can put it into a timeline. 1, 2, 3, 4, 5. All right. Every month OCF is 395,000. Final year here, $72,000 additional. Okay. Initial investment is $188 million. So NPV of all machine is negative 1880000 plus negative 395 divided by 1 point. How much did you do? 8%. 08 power of 1 negative 395 1.08 power of 2 negative 395 1.08 power of 3 1.08 1.08 power of 4. The last one, add up together. Okay, so this is positive, this is negative, so become 3 negative 323,000, 1.08 power of 5. Count this one by one, add up together, you will get your NPV. So this new machine NPV will total up to give you a negative figure also. Because negative figure, then a lot of negative cash inflow. So you're gonna be negative 3,408,118.47. All right. So now you already got your own machine NPV, 3.4 million versus 3.39 million. So which one actually cheaper? Okay, new machine will only cost you today to spend 3.39 million. But if you remain using your old machine, you will end up spending. Oops, all this fly up. You end up spending $3.4 million instead. So from here, you will choose the machine with a lower cost. So in this case, the new machine has a lower cost. Okay, has lower cost. You spend a little bit lesser compared to the maintaining an old machine. So I know this kind of question is very lengthy, and the information might be a bit too saturated. So what you need to do is you need to slowly break it down when you have the time to rewatch whatever that we have done today. All right. So any questions so far? Anyone having any difficulty or already lost? Come on, voice it out to me before you are too lost. Scroll up for old machine. Here? Where? Tell me. Old machine. All these are old machine parts, huh? Anyone else with questions other than scrolling up and all? Can you understand or not? Can you follow or not? Do you know what is the reason of you doing this evaluation? Okay, so this kind of evaluation is basically wanted to see whether a company should proceed with buying a new machine instead of repairing their old machine. Okay, they're comparing. If buy a new machine, it's gonna cost them 4.3 million. But maintaining the old machine, which they could sell, C5. What is C5? Okay, cash flow year 5 here. Yeah. In the 5th year, on the year 5 cash flow, you must always include back the salvage value, because that's the end of the lifetime of your machine, but yet it still can be sold off with the value. Okay, anyone else include back only become 467,000? No, because one is positive, one is negative. What? $72,000 you receive, negative 395,000 you spend. So you are spending lesser in the 5th year. What? Okay. Some more? Anyone else? So by the way, to all of you, why do I show you this long NPV method? Why I don't just use the PVIFA that I showed you last week? So this is 3, this 4 is repetitive, right? By right, I could just straight away take the PVIFA of 4 years and 8% multiply by negative 395. Then you'll be easier a lot. So why I never implement the PVIFA or show you the PVIFA table today? Because apparently what I found out from your module leader or your lecturer you are not provided with the PVIFA table in your final exam. Okay, you're not provided with the PVIFA table for your final exam. So even though you don't have the table, you can still use PVIFA actually. All right, you can still use PVIFA actually to make life easier, because you write like this is actually very slow. So you want to make it easier, PVIFA is actually like this. 1 minus 1 over 1 plus r, this is 0.8, 0.08 here, power of t, which is 4 years, divided by r, 0.08. This is the formula of PVIFA. So once you get this figure, you multiply by negative $395,000. Okay, you get a lump sum here. Then only you plus the following one, divided by, discounted by 1.08 power 5 instead. So if this is the same repetitive one, you can still use the PVIFA. But then, unfortunately, your unit PVIFA table is not given to you. So you need to calculate it yourself. So to calculate it yourself, this is the formula actually. Okay, the formula for PVIFA is basically 1 minus 1 plus r power of t divided by r. This is the formula. Okay, so it's up to you. If you think that this is faster, you can do this. Then you need to count one by one like that. You need to click so many things. All right, your own preference. Okay, your own preference, your choice. Okay, so without wasting much time, let's move on to the following question. All right, today's question all very long, but then we only got very little question lah. So let's look at the next one here. The next question here is EAC application again. So suppose we are thinking about replacing an old computer with a new one. All right, the old one costs us 450,000. The new one costs 580,000. The new machine will be depreciated straight line to zero over 5-year life. It will probably be worth 130,000 after 5 years. So that's the salvage value. The old computer is being depreciated at the rate of $90,000 per year. It will be completely written off in 3 years. If you don't replace it now, we will have to replace it in 2 years. You can sell it now for $230,000. Okay, in 2 years, it will probably be worth $60,000. So the new machine will save us $85,000 per year in operating costs. The tax rate is 38% and the discount rate is 14%. So this question, all right, this question, why we need to convert it to EAC and not just NPV? Okay, it's very simple, because the timeline is different. All right, the timeline is different. Okay, so they got different lifetime. So for the new one, it can survive for 5 years, but an old computer can only survive another 3 years. You need to replace in 2 years time. Okay, so let's start. How do we evaluate this kind of question? So start with the new computer. Again, you need to use the income statement. All right, like the one we did previously. So for new computer, okay, so there are two methods here. So you want it to be simpler, you can just use the depreciation tax shield approach. But I don't recommend that. That means you need to remember another thing. Okay, just do the standard income statement like we usually do. All right, so now the costing here, we started with costing. So the operating of this new computer will give you cost saving. Okay, they give you cost saving of $85,000 per year. Okay, then of course you need to less the depreciation lah. So how much the depreciation here? So just take the new computer will cost you how much? $580,000. $580,000 divided by 5, it's 116,000 per year. So depreciation is 116,000. So now positive 85 minus $116,000, you get your EBT. Of course, it's a negative figure here, negative 31,000. Okay, minus of your tax, again tax credit, so it's a negative also. Negative minus negative become negative plus, right? So this will become negative 19220 only. This is your net income. So net income not done yet. You want to count your OCF. OCF will be net income plus depreciation. Okay, negative 19220 plus $116,000, you get 96,780. This is your operating cash flow for your new computer. All right. Then, as usual, just like just now what we did just now, you need to count the after-tax salvage value. So this new computer, they are telling you it will probably be worth 130,000 after 5 years. So 5 years later, the salvage value is at $130,000. Okay, but this is subjected to tax again. All right, so 38% are being taxed. So that means the value is only 62% of it. This will be 80,600. So this is the salvage value at the 5th year. All right, so now you can start calculating already. So you can use the method that I showed you just now, put in a timeline, easier for you to see. Actually, you don't need to draw the timeline. The timeline is being drawn to you now so that you can see it easily. Again, in the exam, you can draw the timeline one. It's fine. All right. So you know at the end of the salvage value, you will get 80,600. Your operating cash flow is a positive one for the next 5 years. Initial investment, it's $580,000 for a new computer. So now you can calculate your NPV. Okay, NPV negative 580. All right. If you don't want to count this one by one, so this will be plus 96,780 times with 1 minus 1 plus the R is 14%. So 0.14 power of 4 divided by 0.14. And the last one will be 80,600 plus 96,780. So 177,380. Okay, 177,380 divided by 1.14 power of 5. Then you give your answer. Okay, you can do this. This is the PVIFA. You can see, right? I showed you just now. This is the PVIFA. All right, you can see do like this. Okay, if not, you want to write down one by one. It's up to you also. Whichever is more convenient to you. All right. So this is NPV at 14%. So in the end, you can manage to get your NPV now. So again, it's going to be negative lah. Of course, usually, because you see the cost. This is a cost. So get a negative 59,971. This is for new computer. Again, this is for new computer. All right. So now, move on to old computer. This is a bit confusing here. Okay, this is a bit confusing here. So, your old computer, you want to find the operating cash flow here. Okay. So your operating cash flow for your old computer here is $90,000. It's being depreciated at a rate of $90,000 per year. All right. So it's straight away $90,000 per year. Okay. So it's only depreciation, got no other costing to it. So when it's only depreciation, then you need to calculate the depreciation tax shield. Okay. The depreciation tax shield. So your OCF will be consisting of the depreciation tax shield. So basically, your depreciation multiplied by tax. Okay, this is the depreciation tax shield approach. All right, because your old computer got nothing else, no extra income coming in, or no extra costs occurring, or no operating cost saving, or no maintenance or whatsoever. So basically just depreciation. So the OCF is consists of depreciation multiplied by tax. Okay, so this one will be 34,200. This is your OCF for your old computer. Okay, all right. So once you got this, you must remember also that your computer, okay, your old computer can currently sell at how much? All right. The current price, we can sell it now for $230,000. Okay, so in 2 years' time, it will probably be $60,000. So that means it still have 2 years lifespan, but now it's still worth $230,000. So I told you, just like the previous question, the opportunity cost. All right, the opportunity cost. So let's count the salvage value. The salvage value currently worth $230,000. You want to count the difference of the tax shield. Okay, so currently is $230,000. All right, but then got 3 years to depreciate. So that means your depreciation is 90,000 per year. Just now we counted here is 90,000. Not counted, like it's given to you. Times 0.38. So depreciation for 3 years is 90,000 to straight line to zero, right? So 90,000 times 3, that means now you still have 270,000 as book value. Okay, so you need to count the book value. Count book value. Book value not given to you. So now still got 3 more years left. 3 years left multiplied by your depreciation because it's straight line to zero. So your book value is at $270,000. Okay, times your tax here. So your salvage value currently will give you 245,200. Now, this is for now. Okay, this is your opportunity cost or your investment cost. Okay, so the actual salvage value, all right, salvage value at the end of asset's life. All right, you can only sell at $60,000. Okay, you can only sell at $60,000, and then you need to minus off the tax shield also, so which is selling at $60,000, depreciation book value, okay, salvage value minus book value times the tax. So in the end, once the asset is already reached its maturity or reach its expiry or wanna spoil already, you can still sell at $60,000. But you want to count what is the book value. Okay, so here in the end, because of the tax shield, you are selling it in the end at a higher value, $71,400. Okay, $71,400. So now you can put into a timeline like what I showed you just now. 0, 1, 2, 3, 4, and 5. So your operating cash flow is 34,200 per year. This final year, you can salvage it at 71,400. Initial opportunity cost is 245,200. So count your NPV now. Negative 245,200 plus 34,200 times PVIFE 14%. Okay. And how? So one issue here that I mislook and you mislook also. All right. You've forgotten that if you're using the old machine, the timeline is different. So it's not until the 5th year. Again, if you read the question, they tell you, if you don't replace it now, we will have to replace it in 2 years' time. Okay, so it's gonna be only for 2 years. So here you will receive your 71,400. All right. So in this case, you don't even need to use PVIFA. 34,200 divided by 1.14 power of 1 plus, okay, +71 plus 34 is how much? 105,600. 105,600. 1.14 power of 2. So this will give you your NPV for your old machine. This NPV also again wrong. Mislook it a bit. 205,885.31. So sorry. Okay, that's the NPV. And this one, how much? Negative 133,944.23. Okay, this is NPV. So you see the NPV of the new computer is negative 205,885.31. So you'll be thinking, oh, this NPV is so expensive. It costs you 200,000 for 5 years. And this one is only $133,000. Okay, but remember, $133,000, 944 is only for 2 years. This is 205,885 for 5 years. So this is the problem here. Both of them are not equal lifetime there. So the NPV could not be the determining of your decision making. So you need to convert these two NPV into EAC. You convert both of these NPV to EAC. So you'll get your EAC of your old computer. Okay. So I hope that you remember how to use your EAC. All right. EAC equals to NPV divided by PVIFA. So EAC equals to NPV divided by PVIFA on the percentage, okay, on interest and time. So the NPV for your first computer, for your new computer, is negative 205,885.31. All right, so divided your PVIFA is means 1 minus 1 over 1.14 power of 5 divided by 0.14. This is basically your PVIFA. So this will give you your EAC. Okay, this will give you EAC, your estimated annual cost. Then you can compare a year-to-year basis. So annual costing annually is negative 59,971. This is the one that I give you wrongly just now. Okay, so now you count the EAC of this new computer, sorry, old computer. So the NPV here is negative 133,944.23. Divide the same figure here. You counted this figure, right? Just plug it in here. All right, so I won't go and repeat the whole thing. I'll just PVIFA at 14% and 2N. Okay, 14% and for 2 years. This one is for 5 years. You cannot plug in. Sorry, my mistake. So this is Pvifa 14% and 2. The end need to change to 2 because only for 2 years. All right. So this will give you a costing of yearly costing 81,342.95. So from here, you can see which one is actually cheaper. The new computer is only costing you 59,000 per year, whereas the old computer is a bit more expensive. So better off you just sell it off and get a new computer. Can digest. Need time to digest or not? Or you need time to ask me any questions? Come, I'll give you some time. If any issues, please let me know. Come on. Need time to digest. So need time as in you need time now or you need to after the tutorial or what do you mean? Other than February, the rest all, are you all having issues or not? You're only on tutorial 3, yeah? And you already have issues. It's I understand it's a bit complicated. I couldn't make it simpler. It's the best I could do now. So I'll give you some. I think you guys need to take some time. I cannot pressure you too much. So whatever being recorded will be on the YouTube channel, but it won't be immediately there. Now it's there, but after that, if you want to rewatch it, it might take some time to have it appearing on my channel. So if you couldn't see today, refresh it, and then maybe you can see it tomorrow, or definitely can see tomorrow. The day after, definitely you can see it there already. But a lot of students have been saying they couldn't see it instantly. So give it some time. I think maybe because the YouTube's maintenance have some issues or whatsoever. The setting all have been set there to be public and is available to everybody. So use this chance if you couldn't understand what I delivered to you in the class, or you think it's too fast, or you don't know where to ask me, or you need to rewatch it to revise yourself first, then feel free to do so. Then after that, if you have any issues, you can send email to me, or you in worst case scenario that you needed to see me, then you can make an appointment with me by email. Then I see when is the available time, or we could arrange a time for further consultation. Okay, Ken, is this the best solution? I think this is the best solution for now, because if I ask you to digest now, you'll be very stressful. You don't know what to do. You cannot control my page also. But if you watch it on the video, at least you can play back and whatsoever as we go on. All right, agree? Yeah, are you okay or not? Are you all right with this? What do you call that? Solution. Okay. All right. I see some responded. Some responded to me, but the rest I don't know. I got 32 students, by the way. Okay. Okay. So good. I assume that those who did not voice out your opinion, you are agreeing with it also. So unless you're objecting it, you can also mention it to me anytime throughout the whole session today. All right, at the chat room. Okay, if you're shy to let people know, you can even PM me. Okay, you can private message me or say, "So I don't, I disagree with the way you arrange things. I wanted you to clarify this now itself." Okay, then you let me know. All right. But if I clarify now itself, attending to every single student's needs, it will be too time consuming. You see, we only go through 2 questions and it take up 1 hour. All right. So you see, if I ended early, if you have any issues, then you can come and ask me. Okay. So let's move on to the third question. All right. Let's move on. Cost of excess capacity here. The President Executive Jet. So you are determining now, your boss jet. What are you going to do with it? The President's Executive Jet is not fully utilized. You judge that its use by other officers would increase direct operating costs by only $20,000 a year and would save $100,000 a year in airline bill. On the other hand, you believe that with the increased use, the company will need to replace the jet at the end of the 3 years rather than 4. So the lifespan of the product has been shortened. Okay, so you need to calculate, is this value or not? A new jet costs $1.1 million. Okay, and at its current low rate of use has a life of 6 years. All right, because of it not being used often, it can last for 6 years instead of just 4 years. Assume the company does not pay taxes. All cash flow are forecasted in real terms. The real opportunity cost of capital is 8%. Should you try to persuade the president to allow other officers to use the plane? Okay. So this kind of question, you need to first find out the EAC. You want to see what is the annual cost per year for a 6 years life jet. So if let's say you remain it as now, all right, never go and use it for your other officers, how much is the operating cost? Okay, how much is the annual cost that you're spending here? So let's look at this. All right, EAC. Okay, EAC, you know, is equals to present value divided by PVIFA, percentage and interest and time. So in this case, the present value, all right, a new jet costs you $1.1 million. This is the present value. Okay, so count the PVIFA of how many years? PVIFA, okay, at 8% for 6 years. Okay, for 6 years. So this will give you an amount. So you count up PVIFA with the formula I gave you just now. All right. So you should be getting around 4.6233 something. Okay. So 1.1 million divided by your PVIFA of 8% and 6 years. Okay, and N6, you will get 237,941. This is your annual costing if your jet can last for 6 years. All right. Okay. Now, you change the thing. Okay. You want to count what happened if the jet is replaced at the end of year 3 rather than 4 years. All right. So how do you count this? Okay. So now you want to count the present value of cost. How much it will cost you if it can only last for 3 years rather than 4 years. All right. So okay, so if you only this present value is for 237,941 for each year, right? So now you want to count the cost if it's only lasted for 4 years. Okay, for 4 years. So how much is it? The balance there. So 237,941 divided by, you're discounting backwards. Okay, so you get 174,894. This is the cost that you will incur if this plane by right, okay, if it's being used by the office by the standard procedure or the standard lifespan is only 4 years. Okay, if the standard lifespan is only 4 years, so this is the cost. This is the incremental cost in year 4. Okay, that you will incur. So this is the value here. All right. Now, if you share you share the plane with the officers. That means now everyone can use the plane. Okay? If everyone can use the plane now, they calculated initially air bill is costing $100,000, but now it's only $20,000 extra if you use the plane. So you save $80,000 per year. All right, $80,000 per year, and $80,000 per year, you can use it for 3 years. Right? The question tell you, if it's being used by officer instead of 4 years, you will need to replace it at 3 years. So $80,000 for 3 years. Cost saving for 3 years, 1.08 plus 80,000, 1.08 power of 2 plus 80,000, 1.08 power of 3. So total all these three together, what do you get? You save $206, 168,000. This is the total saving. Okay, this is the total saving. All right. So the cost of the present value of the cost, okay, just now $237,000 per year, right? If it's being used for 4 years, by right, for 4 years, all right. So it's actually 174,894. Okay, but now with this usage, you have extra saving of $206,000, 168, 206,168 overall for all these 4 years. So your cost is 174, but now if you share with the officer, you save $206,000. So your present value of saving is more than your cost. So in that case, you should allow wider use, more value for money. All right, you might be very confused now. So what are we doing now here? Let me explain to you easily. So initially, all right, this one new jet could last 6 years. Okay, one new jet by right can last 6 years. All right, so if it's lasting for 6 years, at average, each year the cost is around 237,941, because assuming $1.1 million to use for 6 years lah, and then including on the discounting factor. So each year costs you 237,941. All right. Then now you want to count. By right, the plane can only last for 4 years. Last for 4 years. So if it lasts for 4 years, you want to discount this 4th year backwards into today's value. All right, which is 174,894. This value is missing. You lost this chance, because now if you share with other officer, you can only last for 3 years. Okay, so your cost on the 4th year is this much. After discounting to today, this is the costing value today. All right, can you get back this value or not? That's the question. So by sharing it with your officer, each year you get an extra of $80,000. So it can run for 3 years. So $80,000, $80,000, $80,000. This is in the future cash flow lah. So you go and discount it backward to today, you actually receive in total $206,000. So can this $206,000 compensate your cost of the cost that you might lose for the 4th year, since this now is shorter by 1 year life? So yes, it compensable. It can compensate it off. This $206,000 is much more than the cost by almost $30,000. So it's much more value for you to share with your officer instead of let the plane to survive 1 extra year for the president usage only. Okay, so by giving out to more people to use, you actually save more. And then that saving actually covered whatever you buy me wasted, whatever that you might have you don't have the privilege of using another year, or you might need to buy a new jet earlier. So this is what it means. This whole question means that. Can you understand or not? I hope that the story will make some sense. Anyone need me to repeat the story? Come, don't be shy. Hello, boys and girls. Are you okay? Do you need me to repeat the story? Or you're okay with the story? Or you're already perfectly clear about the story? Okay, for Achana. The rest? Anyone, please don't be shy. Anybody who cannot get the story, you wanted me to repeat, let me know now. Okay? Let me know now. Don't wait. Because this story is very hard to be replicated to you in the email instead. Scroll down a bit more. Yeah, this is the end. Can cannot? Are you all right? Not a single person needed clarification. That means all very good. Hello, no issues, huh? Okay. So no one questioning me or no one issuing any questions. I assume you are all right then. So I move on. Again, I move on to this last question. This last question looks easy, but might be a bit confusing also. So let's look at this. Optimal timing of investment, or in other words, when should you invest? So you own an idle silver mine in Chile. You can reopen the mine now and extract the remaining silver by investing $200 million, 200 million pesos, and committing to extraction costs with present value 200 million pesos. Okay, the present value of the silver is 500 million pesos. So that means today it's worth $500 million. All right, but for you to extract, you need to invest $200 million. Okay, the extraction cost per year is $200 million. However, technological advances will reduce the present value of extraction cost by 12 million peso a year to 188 million peso in year one, 176 million peso in year two, and etc. That means you go on. So extraction cost will be cheaper over the years. All right. So prepare a forecast showing the NPV changes. If the mine reopening is delayed to year 1, 2, 3, 4, or 5, assume that the price of silver will appreciate by 4% per year. When should you invest if the cost of capital is 14%? And what if the cost of capital is 20%? Okay? Right. That's all for the question. So let me show you how to do this question. All right, it's easy. It's not complicated, but it's quite confusing somehow. So let's see. Yeah, you can open the mine in either this is year 0. You can open it year 1, 2, 3, 4, or year 5. Okay. All right. So the present value of silver currently is $500 million. Okay, $500 million. So they say there will be an increment of 4% per year. All right. So silver price will add 4% per year. So to count for number one here is 500 multiplied by 1.04. Then you get 520. To get for year two, 520 times 1.04. You get 541. Year 3, 541 times 1.04. So it become 562. Year 4, 562 multiplied by 1.04. You get 585. And the last one, 585 multiplied by 1.04, you get 608. So this is the silver price growing from year 0 all the way to year 5. Okay? And then to extract, each year you need to invest $200 million. This is not extraction fees. This is investment fees. Each year will be $200. Extraction fees also need to be deducted after that. Extraction cost on the first year is 200. But every year onwards is 12 million discount. So 188, 176, 164, 152, and 140. So this is all the revenue and the costing. This is your income statement basically for 5 years. So now you want to see your net cash flow. 500 minus 400, 100. 520 minus 388, 132. 541 minus 376, 561. 562 minus 364, 8, 9, 1. 5 minus 352, 3, 3, 2. 608 minus 340, 8, 6, 3. Nope, 2. 268. Okay? 268. All right, this is your net cash flow. So having this net cash flow already, the question asks you, assuming the price will be at 4%, when should you invest if the cost of capital is 14% and the cost of capital is at 20%? So basically, this is NPV lah. Okay, this is your NPV for each year. All right. So the first year one you don't count because the NPV is definitely going to be same. So you count NPV when it's at 14% and NPV when it's at 20%. So this one, no discounting factor. But here will be discounted. 132 divided by 1.14. So for NPV 14, the answer here will be 132 divided by 1.14. Power of 1. What is the answer? Here, 132 divided by 1.2. Here, 165 divided by 1.14, power of 2. Okay, I won't give you the figure first. I'll give you here the formula. 1.14 power of 2. Here, 165 divided by 1.2, power of 2. 198 divided by 1.14, power of 3. 198 divided by 1.2, power of 3. 233 divided by 1.14, power of 4. 4 outside. 233 divided by 1.2, power of 4. And lastly, 268 divided by 1.14, power of 5. 268, 1.2, power of 5. So all this will give you a figure. All this will give you a figure. Then I don't know whether they got enough space to write it now. Let me see where can I cram it. All right. So this one you'll get 115.79. Here 110. 126.81. 114.44. 133.94. 114.83. 137.91. 112.33, and 139.36, 107.83. These are all the present value for each year if you start. If let's say you start on year 1, this is the NPV. If you start on year 4, this is the NPV. Okay, so now they ask you, since you already calculated for 5 years, when should you invest if the cost of capital is 0.1 is 14%? So you want to find the one with the highest NPV. So in this case, on NPV 14, the highest NPV will be on year 5. So you will start investing on year 5 or start operation on year 5. That will be the most profitable. If it's at 20%, the one that will give you the highest one will be at year 3. Okay. So So it's actually very easy, but it might look a bit complicated, especially the NPV section here. So may I know, is there any students that send complications so far? Come on. Hello, are you there? No one in the class is in, all sleeping already. So far, so good. Okay, so this is the last question already. So you have any questions, better start asking me. All right. Or you're rushing to go somewhere. Very long, very long explanation. Just for one class, I already lost my voice. So the symbol that I calculated with you has small. Never mind. Small difference is fair. It's fine. Because mine might be a bit rounded up earlier on. So your one is okay. If it's a small fraction of changes, it's fine. But is it still the same results or not? Does NPV 14 still shows that year 5 is the most profitable? And NPV 20 show year 3 is the most profitable or not? $114.58. How come? Let me see. 165 divided by 1.2 divided by 1.2. 114.58. Okay. 198 divided by 1.2 divided by 1.2 divided by 1.2. Wait, what is this? 198 divided by 1.2 divided by 1.2 divided by 1.2. True. 114.58 also. Let me see. Okay, so this most likely because of the what happened here on the silver present value. All right, because we drown out too fast. Okay, so if this kind of situation in the exam, okay, so by right you cannot simplify so much lah. 500 million peso means you need to show all the 6 figures. Okay, but if you never show the 6 figure, you show exactly like this, you have a same one, then you could say that you could invest on either year 2 or year 3 because they are having the same figure. As long as the evidence that you show, okay, or the equation calculation that you show have the same similarity, you'll be acceptable. What about the 14% one? Well, 14%, this will be still the highest, right? Yeah, sometimes it's because here we already round up too early because this is a 4% growth rate, right? So 520 times 1.04 is more than $441,000. But we round it down. This one we round some of it round it down, some round it down, then you make the figures you get is quite similar. All right. So yep. All right. This calculation is basically use Excel. We use Excel. That's why you round like that. But then Excel can still give you very accurate decimal point. That's the thing. But if you use calculator, then of course it's a bit different. All right. Okay. As far as I know, you can still use Excel in your exam because it's online. Okay. But you could not use PVIFA table because it's not provided to you. All right. I think that clear things up. So very good question there that Fabian actually tried it and find out that there's a difference in value. So that's very good. All right. So now I explain to you. I hope that gives you a better understanding or you are clear because all these calculation, all these solution are calculated with Excel. I'm using Excel, so that's why the outcome could still be so precise, but very generalized on the variables before that. Okay, just like last week, just like what I showed you last week. All right. So other than that, come, I share with you your camps for those who might want to leave early. Okay. So I should have 32 respondents for your attendance. So those who already have no issues, you may mark your attendance and proceed on with whatever, or you can dismiss yourself, and I'll see you next week. But those who have questions that you want to further address it to me, you may stay. You're welcome, Emeline. I'll see you next week. Question 33, old machine salvage value. Question 33, yeah. Okay. Question 33, old machine salvage value. Right. So the salvage value of the old machine is how much? They tell you in the question is we can sell it now for 230,000. So that means the current salvage value is 230,000, but in 2 years' time, it will most probably be $60,000. So the salvage value is $60,000. All right. You want to count the book value. Okay. So you still have 1 more year to go because it actually take 3 more years. But then you're forced to buy again in 2 years' time. That's why you need to deduct the third year depreciation, which is $90,000. And then with that, you get the tax depreciation also. What depreciation tax shield. Understood, Yichi? You see, by right at the end of the salvage value in 2 years' time can be set at $60,000. But your old machine will only spoil in 3 years. So by 2 years, you already need to change it. So 1 more year extra there, which need to be depreciated. So that means it still has a book value there. All right. So you sold it 1 year early at $60,000, and then minus off your depreciation, you still get a tax shield. Okay. In other words, to call it tax rebate. All right. If you are selling on the final year itself, there's no more depreciation. It's straight line zero. So you 60,000. Okay, and then you need to deduct your tax. But in this case, you need to add up because you still have depreciation. You still have 1 more year to be depreciated. So you get a depreciation tax shield. Can. Ichi, cannot. No. No. It's 60,000 minus salvage value, deducting book value, times tax. Okay, I'm sharing the attendance because some of your friends are not here. So as I shown just now, it should be 60,000 minus salvage value of 60,000, deducting your book value times 0.38. This is how it's supposed to be. So negative become positive. That's why it becomes 71,400. The final answer is 71,400. Yes, Fabrin Wong is correct. Wong Fabrin. Because you need to know the after tax salvage value formula is salvage value minus salvage value times tax. This is the formula. No more consultation hour this week. My consultation is supposed to be 8 o'clock. You should come and ask me. What is there? What is it that you want to ask about your individual assignment actually?
No, so I just want to ask a few questions regarding to the first question in the assignment.
What is that? Again?
The first question in the assignment about the CFA handbook.
Okay.
Just a minute. Yeah. If the question asks us to discuss on the professional conduct of this person, so I should actually apply the CFA standard from the handbook and then relate it to whatever this person did in the company, right?
Yeah. Just like how we discussed on the previous tutorial.
Yeah, like tutorial one, right? So I just relate it like the conduct and also what she should do and then how it relates to the CFA standard.
Yes, exactly.
Okay, yeah, got it.
All right. Okay, good.
I want to consult you again next week. I need to email you, right?
Yeah, you must let me know if you want to consult me. Let me know you want to see me. Then I will let you know to come to the link. Then you can see me and then you can consult me then. So let me know in email. It's easier because then I can arrange the time.
Yes, but sir, I don't know why I couldn't reach your email. I tried yesterday, but then
You don't reach my email. My email is this. So I think there are mistakes there in the or wrong email. I don't know. This is my email.
All right, I'll try to email again next week.
Okay.
Thank you, sir.
All right. If you can't do that also, can't email me also, then how can you contact me? Let me see.
I'm sorry, so I couldn't hear you.
No, I'm thinking of another way. If you can't contact me, how you gonna find me? Let me see. Let me double check whether I give you the correct email. Yeah, worst case scenario, message me on Times. That's the worst case scenario, because times I don't really go into times. That's the thing. Okay, let me see my email. Yes, correct. I give you the correct one.
Okay, I'll
All
try
right.
to email
Okay.
again.
Okay. Okay.
Thank you, sir.
We choose. All right. So attendance all done, huh? Let me see. Yes, 32 done. Very good. So okay. So do you have any questions? I see some of you are still here.